Our next guest says he's taking a much more active approach to right-sizing the risks in his portfolio, no matter what those risks are or where they come from. Now, he says he sees some attractive opportunities, not just here in the U.S., but especially overseas. Joining us now is Matt Rowe, the managing director of solutions at Man Group, the world's biggest publicly traded hedge fund. Matt, thank you very much for joining us here. Let's talk about right-sizing risks in a portfolio. If you work for a group like Man, you have to be risk aware. Why do you think now is a good time to think about what your risks are and how to minimize or right-size them?
Yeah, well, thanks. Based on where we've come from the dip after the original Liberation Day, we've had a significant move higher in equities. We've seen credit spreads tighten, and all forms of risk have really rebounded in a very dramatic fashion. The Nasdaq is up over 30%. The S&P is up over 25% from that dip. So when I look at things like the performance in the recent history and relative value across the globe, you can look at a high level at places like Europe for lower PE ratios, lower CAPE, with a higher dividend rate. So if you've enjoyed the benefit of this rapid rebound with a concentrated U.S. exposure, particularly in momentum and some of the large cap techs, I think it's a good form of discipline to look to trim some of those profits, take down your risk profile a little, and diversify away from what is still a highly charged situation here in the U.S.
All right, so if you rebalance, how exactly does one do that? We know sophisticated investors like yourselves and hedge fund traders and investors do it a different way. But as we talk about smaller retail investors and maybe small investment advisors, is it through ETFs?
Yeah.
And what specific geographies or types of products would you use?
Yeah, I think, look, you can use many different types of products. And when we're referencing indices, obviously those indices are built of a bunch of single names. So depending on where you want your exposure, whether it be sector-based, factor-based, you can just look to get exposure in different geographies, right? So if you want to look to, say, play the consumer area, you could look to investing in European or non-US European as a diversifying agent. I think the diversification theme is going to be one that we look back on at the end of the year. And those that don't do it, I think, are going to wish that they did, because we are still living in a very highly charged situation right now. The tariff situation, while we keep pushing out the date where we're going to see the V2 or the final date that we get to, in the meantime, tariff rates for the United States, for consumers, for businesses, are still relatively high, more than 3 times what they were prior to the beginning of April. So the status quo is one with a lot of economic friction. And I think people are, kind of pushing that to the side and hoping that's not the case.